Okay, today, Star Shifter 9. We will definitely not finish it today, but we will start it today. Okay, so let's take a look here. Okay, so Chapter 9 is on long-term assets, and the part that we're going to really look at is depreciation. This is a chapter that we could quite literally spend an entire quarter on. There actually are college courses on just fixed assets, which is what these are. But if you go all the way to the end of it, I'm going to talk a little bit about it. So this is page, what is this, page 7? Write that in. So go to page 7, last page. Okay, so on page 7, I gotta move this right. Can't look at my screen. On page 7, we have what is depreciation? Depreciation is an allocation. An allocation just means you split it up. So, you know, if you had, I don't know, you had six cans of pop, you had 3 people, you'd allocate 2 to each person, right? I mean, it's the same thing as splitting it up. So allocation is just splitting up the cost. And you split up the cost for a long-term asset over its life. Usually, you know, whatever it, however long you think you're going to use it for. Because usually for long-term assets, you're going to use them for more than one period. So an example I give is that you buy a machine, purchase for $800, and it's going to have a life of 8 years. Well, you're not going to expense the whole machine in year 1 because you're going to use it for 8 years. So you're going to allocate, okay, just like spinning up the 6-pack of pop. You know, you have 3 people, you give 2 to each person. Same thing. We're going to take the $800 and split it up along 8 years, which means $100 a year. So every year we're going to depreciate part of that equipment. So it's allocating the cost. It's saying, okay, here's the cost of it. We're going to spread it out over the life of it and allocate some of that cost each year because we're going to be using it every year. Okay, now this is somewhat important. Depreciation is not meant to find the market value of an asset. So, for instance, the machine, we purchased it for $800. If we go down 3 years, you say, okay, well, we've expensed $300 of it, so it's what, $500? That's not necessarily the market value for the machine. The market value of the machine might be higher than that or might be lower than that. It could also be that, but it would be just a coincidence. So we're really not trying to find the market value. We're simply taking the cost and splitting it up. Now, it's possible that it is close to the market value because, as we know, over time, things become worth less usually. And if you usually buy a car and as time goes on, it's worth less and less. So we have that. We know that happens, but it's not really meant to do that. It's meant to just split up the cost. Okay. Residual value is an estimate of the asset's value at the end of its useful life. So whatever it is at the end of its useful life, that's residual value. And it could be different depending on how long you plan on holding something. For instance, if you buy, let's say you buy a truck for your business. You might be in a business that requires that you have a new truck, every couple of years or every 3 years or whatever. I had a father-in-law who was a sales rep, and because for auto parts, and so they would always have, I think 3 years is as long as they ever went with a car, because their customers were auto people, and they were trying to sell them the newer parts or what's coming out and all that kind of stuff. So anyway, buy a car, you might, one company might have it for 3 years. There might be another company that buys a car. We're going to drive the thing till the wheels falls off. So we'll have it for 10 years or 12 years or something. So it really, the useful life is really up to whatever the company is, and the residual value obviously will be, will correspond to that. A car that's 3 years old will probably have a higher value than a car that's 10 years old, and so forth. Okay, residual value. This is a term that your book uses, and there's nothing wrong with that at all. Another term you often see, though, is salvage value. So if you see salvage value, same thing. And these other ones are also things you'll also see: scrap value, terminal value, ending value. They all mean exactly the same thing. They're all the residual value. Any question on that? Okay. And we know about the accumulated depreciation account. We've actually used it before. And I think I've actually done this, went through this with you guys before. But the question is, why do we use it? Why don't we just write off? We bought this equipment for $800. Why don't we just subtract out the expense out of the equipment? $800. Next year we take $100 out. The equipment will have $700 in the account. Another $100 at the end of the year is $600, and so on and so forth. Why don't we just do that? Two accounts: depreciation expense and whatever the asset is. Well, we don't do that. First of all, there's nothing theoretically wrong with that. But having the accumulated depreciation account, I'm pretty sure I told you guys this before, but it's quite possible that it gives us more information. And so, for instance, if we have two pieces of equipment that have exactly the same book value, they're both worth $5,000. This would be on the balance sheet. Equipment A, 5,000, equipment B, 5,000. But giving the reader the accumulated depreciation tells kind of a different story. If you just look at the book value, you say, oh, these are probably, pretty similar pieces of equipment, right? There's $5,000. However, equipment A is very expensive, and it's very old. It's probably close to the end of its life. And you may say, well, okay, that's fine. Well, the problem with that is that you're probably going to have to replace equipment A. And equipment A isn't cheap. Equipment A is $125,000. So, the idea that, if you're reading this, that you're probably going to have to make a pretty big outlay of cash pretty soon, or you're going to loan or something to replace this piece of equipment. Whereas equipment B, well, first of all, it's much less expensive, and it's probably much newer. So, if you compare these two, this is relatively, anyways, expensive. Whereas this is inexpensive. And this is probably older. depreciated quite a bit, and this one is newer. Oops. So, this one's going to need to be replaced. And actually, the more important lesson here is if you look at A is probably going to need to be replaced, and A is a big, a big deal. Equipment B is kind of a big deal, and then not nowhere near the size of a big deal as A is. So, anyway, that's why we use the accumulated depreciation account, because this account, while it's kind of irritating, but it tells us a lot more information. It makes things a little bit more complex, but the information is worth it. How about that? Okay, well, let's go to the first one. I don't know why my headers are always, whenever I open them up, they're kind of funny. I'm not sure why. Not anyway, my problem. All right, so let's go ahead and start on a straight line. Okay, so a truck, leaving green. A truck was purchased for $32,000. The residual value, okay, we just talked about that, and let me put all this stuff up here, and then I'll talk about it. Okay, so at the end of its life, in 5 years, this truck is going to have a value of, we estimate that this truck will have a value of $8,000. Now, you might be wondering, both of these are estimates. So, you might be wondering, well, how do you come up with that? If the company's been around for a while, you do, what happened in the past? How long have we, is this a truck? How long have we kept the trucks in the past? What was the, what was the resale value afterwards, and all that kind of stuff? Yeah, you can also, they have all kinds of stuff for pricing cars and trucks and stuff. You can look up to see what a truck is 5 years from now, and use that as kind of an estimate of what this will be worth. So anyway, so we have these two estimates, and here's the question. I'm going to just get rid of the underlining there. How much or it's not coming to me. How much will the truck decrease in value over 5 years? We're buying it for 32. At the end of 5 years, we estimate that we'll sell it for 8,000. So, what would be the decrease in value over 5 years? You can shout it out or put it in chat. How about that? Oh, come on, someone has this. Nobody?
Is it 4,800?
Actually, you went one step further. Yes, 4,800 a year, but in total, it's going to decrease by
24,000.
Yep, perfect. Okay. The cost. 32,000. Oh, forgot the 3. So it costs 32,000. The residual value is 8,000. So the difference between those two. I'm sorry. Typing is never good. So this is what we call the depreciable amount, which is a fancy way of just saying how much will it go down in value. And I think we're going to move everything over 1. So it's 24,000. So it's going to decrease in value. It's going to go from 32,000 down to 8. So the depreciable amount, which is just this, yeah. How much is it? 24,000. It's going to go from 32,000 down to 8. So this depreciable amount, which is just that, be 24,000. Now, you're absolutely correct in the reviews of 5 years. How much is it per year?
Per year, it would be 4,800.
Yep. So 5 years equals. So this will be the depreciation expense per year. Oops. Can't think of a good way to do that. Okay, so this will be, no, let's make this, make that yellow. So every year, we're going to knock 4,800 off of the value of this. And it would be reasonable for you to say, well, okay, so we're just going to reduce the, whatever we paid for the truck, right? 3,200 is what we're going to reduce it by. Nothing wrong with that thinking. Theoretically, it's absolutely fine, but we're going to use the accumulated depreciation account just because it gives us a little bit more information. So every year we're going to expense 4,800. You remember my morbid way of remembering this is the end of his life. The equipment will be dead. So DPAD, DE is depreciation. Which is not spelled like that, in case you're wondering. Expense. Okay, and the same entry will be down here. You can just copy if you want. But This journal entry will be exactly the same every single year. So every year they'll have the same amount. By the way, usually what they do with equipment is once they buy it, and you work out what the depreciation would be. They usually have a depreciation schedule that you'll have. Today, virtually all is going to be in Excel. But so if you're an accountant, you're not going to be recalculating this every year. There'll be a list of, you'll do it once, and then you'll say, okay, for this piece of equipment, you depreciate this amount in this year, and that sort of thing. So you're not going to be doing the calculations every single year for every single piece of equipment. Usually they have a schedule that you'll actually be using. You do it once, and then because you may have 10 pieces of equipment and you'll have a schedule for each one. Okay. The asset, this is the truck, right? So the asset's a truck. You could also put equipment in there, that's fine. Yeah, I told you guys this. There actually is no, I don't know, accounting rules what you have to call something an account. You call it widgets or whatever you want. As long as you put it in the right spot, it's a long-term asset or whatever. But usually either put what kind of asset it is, or if you just put equipment, that's fine too. Either one is acceptable. Okay, so we paid $32,000 for the truck. And the depreciation, I should have switched these around. The depreciation expense should be $4,800. The reason I put these two kind of go together. These two accounts, they're kind of connected. So they'll go together forever. So anyway, so I can put those two here. So this would be 4,800. And the cumulative depreciation is just all the depreciation up to the current date. Now, in year one, there's only, this is only 1 year's worth of depreciation. Now, the book value is now the truck minus the accumulated depreciation will give you the book value. So 32,000 minus 4,800 will give you that. Okay, time for Mr. Calculator. All right. 32,000 minus 4,800, 27,200. So that is this minus that. I had a better way of doing it. Okay, now the truck account will stay exactly the same every single year. Nothing changes in that account. So you can actually fill this in if you want. The truck account doesn't change. Okay, so now we depreciate another 4,800. So the accumulated depreciation now will be both years together. So accumulated is just keep adding it up. So it'll be the depreciation from 2021 and the depreciation expense from 2022. So this will be, is that 40, 9,600? Okay, 4,800. Yeah, 9,600. So this is 600. Oops. So 32,000 minus 9,600 will give us new book value. What is that? Okay, so 32,000 minus 22,400. And we just keep repeating that as we go on. So another 4,800 in year 3. Now, if you want, oops, that's not what I wanted to do. I don't know. If you want, you can just take the 9,600 plus this. Will give you that too. But it's basically all 3 years depreciation. So where that is. $8,000. Okay. So 14,400. Okay. 32,000 minus 14,400 is some number. And we'll just keep going. Yeah, so this would be, if you think about this, will just be whatever we have right here for the accumulated depreciation plus, 4,800 every single year. So you just keep adding 4,800 to it. So 14,400 plus 4,800 is. So this is how we, now this is the amount, this is what would be on the balance sheet. Let me write that. I'll do it down here actually. Steve. If I can fit. Okay. You guys have no idea. Mr. Taylor has no idea how to use a computer. That's what we do. All right, so this is the amount that would be shown on the balance sheet. You know, for instance, in 2023, you have 32,000 minus 14,400. So this would be the amount that would be shown on the balance sheet. These accounts would be in the background, and they're there because they give you more information. But this is the actual amount that you show on the balance sheet for say 2023 would be, you know, that. Any question on that? And again, it is kind of quirky that we have this accumulated depreciation, but it's there for a reason. Use a little more information. If you subtract it right out from the truck, we don't do it that way, but there's nothing wrong with thinking of it that way. You know, why don't we just have this truck value go down by 4,800 every year and get rid of this thing? But again, it's good you get a little more information. It tells you how old the thing is, and what it costs to begin with. So, question on that? Okay, let's go to. Oh, wait a minute. I want to tell you why they just call the straight line method. It's called the straight line method because it decreases in value in a straight line. So it looks like this. So let's see, period. So if you were to chart this out, this would be the book value. When you first bought it, it was 32,000. And then after the first year, it went down by 4,800. Bring up the number. 27,200. So it went down to 27. So it went down by 4,800. Somewhere here. then it went down to 22,400 and so on. So this is going to keep going down. You don't line up, but you get the idea. You know, and it's going to go down in a straight line until you know, if it gets down here, this will be 8,000. You know, so it goes from 32,000, and it'll go down the same amount every year. So every year, you know, it'll decrease by 4,800 until it gets down to whatever. So if you were to chart out the book value, it would be a straight line. And it's for kicks from the rest of them. 17,6, 12,8. So every year it'll go down by the same amount. It starts out at 32,000 and goes down to. Okay. Oops. Wrong thing. Now, actually, I want to talk one more thing about this, then I'll go to the next one, and that is these two. You'll notice that I can't quite get it on the same screen, but the 24,000 is that, the depreciable amount. And the 8,000 is that. And that's residual value. That's what we think it's going to be at the end of the 5 years. So this is the depreciable amount. And this is residual. Okay. Let's jump to number 2. Okay, so this is they purchased it for that. Residual value, oops, residual value. That. 10 years. Now we're not going to do all 10 years. We're going to do the first 2 years for these. We could do all 10 years, but so you're going to depreciate it over 10 years, but we're just going to go down the first 2 years. We could do all 10, but just the first 2 years. Okay. $80,000. Okay, so this is the amount that we think it is going to go down in value. It's going to go down in value from 120 down to 40. So, you know, putting it in here, so this will, it'll start out at 120, then it'll go down to 40. So 32 down there. So 120 down to 40. But it'll still be a straight line when you do the same amount every year. It's going to be for 10 years though. This will go out for 10 years. Okay. $8,000 per year. Okay, so this will be the depreciation expense. Okay, so journal entry is exactly the same every time. Depreciation expense. Uh, 8,000. Yeah, you can just copy that. For the straight line method, it's exactly the same. Okay, down here, the asset machine. You know, again, you can put it as equipment too. You put equipment, that's okay. So 120,000. Good depreciation would be, well, this depreciation expense would be 8,000. Oops. And the cumulative depreciation first year would be exactly the same. It's the depreciation for 1 year. Okay, and we. Okay, so 30,000 minus 8,000 is the book value. some number. 112. Yeah. Yes, 12. Okay. And this will be exactly the same. It'll be the same every year. So if we're just doing the first 2 years here, the accumulated depreciation would be both of those together.
16,000.
Yep. Okay, so this would be 104. Okay, so if we're just in the first 2 years, I mean, we could do it. We could do all the way through 10 years. Oops. What did I do here? Isn't this fun? Watch me learn how to use a computer. Okay. Yeah, so that'd be the first 2 years. So yeah, and again we go. And so, at the end of, so this is the amount that you show on the balance sheet for that year. So 2022, at the end of the year, you have a book value of 104,000 for it. And again, it's a little bit quirky because we have that accumulated depreciation account, but it really is there just to kind of give you a little more information. But this is the value of it, and this is what you show on the balance sheet. This may or may not be the market value. It's not intended to be the market value. So, but anyway, yeah, that's it. All right, I think we'll stop there. There's no way I can finish it. There's no way we could finish it by the end of the class. So we'll stop there. Any question on this?
No, I think it's going good.
Okay. All right. Well, let's see. Stop share. I'll put it back up in a second. Well, yeah. Any questions? That'll be it for today. I know some of you guys are getting a lot more of the work, and I'm actually behind on the grading still, which is good. You guys are turning the stuff in. So if you're missing stuff, keep turning it in, and I should have the grade should be up to date by today. So by today, I'll have all the grading in. But I'm very glad you guys are turning stuff in. And again, don't hesitate to turn it in. The handouts are all available. They're in the course. It's called course files. Yeah, in course files, and the recorded meetings are all there. Zoom meetings are all there. So if you're missing anything, you can certainly turn it in, and there's no penalty to do it. One more thing, I know I'm getting preachy here, but I would encourage you to do it sooner rather than later, because your last week of this is week 14, so we have 15 and 16. Week 15 and especially week 16 are usually pretty busy, not so much in this class, but in your other classes. So I would strongly encourage you to get ahead in this class, get all the stuff in, and then that'll free up your last week for group projects and all the other stuff you have in your classes. So anyway, please do turn it in, and you guys are turning a lot of stuff in, and I'm very happy about that. But keep it going, and if you're missing something, turn it in. There's no reason not to. You get full credit, and that's it. Any questions?
Sounds good, Professor. Appreciate it.
Have a good weekend, guys. I'll see you on Tuesday.
Tuesday.
All right.
Have a good day, Professor. Thank you.